Hi, Gary and Kevin here. Welcome to Chicago. It's late April, weather's warming up, but we've had somewhat of a tepid quarter as far as the economy is concerned. Not bad, but at that very slow growth rate again.
Better in the markets, though.
Better than the markets, true. And what we had was the first quarter, actually in March, we had unemployment of 126,000 jobs. It's the first time in 14 months was under 200,000. We'll have to see if that continues. Inflation's still the same. The Fed, they're still making noise about raising rates, but they want the unemployment rate to get down a little further, and they want to see a little more economic activity, and basically pushing it off, looks like now, to December. September's probably out. December's the next time frame, so we just kind of keep pushing that back. But with all that taking place, we had kind of a change in lead this year with stocks in the market. What took place from last year to this year when we look at domestic, international stock markets?
Well, you have to look at last year. The dollar had a big impact on that, with the dollar declining, and that causes a reduction of U.S. companies' profits when they translate their earnings back into dollars. You had the energy issue. You have had slower growth. So you've had these three kind of flux, and a tough winter as well. So, there had a lot of people had baked into their estimates of the first quarter a decline in earnings.
Right.
And it's actually looking to be a bit better than that, flat to maybe even slightly positive earnings in the first quarter. Now, that doesn't necessarily project for the entire year, but it does show that it has withstood a little bit of those negatives. Growth does still seem to be tepid, which is why the Fed is kind of postponing this issue, and the market has looked favorably upon that.
Right. Well, you brought up the energy issue, and we were wondering what was going to happen with consumers. When gasoline prices came down. So in this first quarter of this year, there's a chart you're going to see here that said that basically the consumer saved $112 billion annually in gasoline prices, but $120 billion went into savings.
Right.
So they're just banking the whole thing, and consumers aren't spending money.
Well, it's kind of ironic too. It's like, well, you want people to save because there's a lot of articles lately. It's kind of the hot article that most Americans are under saving for their retirement, and that's a big looming problem for the baby boomer generation. But then again, when they get savings, well, how come they're not spending it? Maybe they're paying debt. Maybe that's in the long term that's positive. I mean, it's not so much how you get there, but it's how you get there, right?
Yeah.
So I think that, with a grain of salt, we're looking for signs of growth and for this thing to pick up in terms of economic activity. But repairing balance sheets, I can't say is a bad thing.
No, not a bad thing. Big Barron's puts big money poll out, and they just came out with one a couple days ago, and it was kind of interesting, Kevin, because they said, and we were talking about this earlier, that 50% of the big money poll folks out there think we got a neutral market going forward, meaning not much going to happen year end. But then you ask them the follow-up question of what's going to happen in 12 months, and 83% are bullish on Europe, and 82% are bullish on the U.S. So, are they speaking with forked tongue? What's that all about?
Well, this market, as we've been talking about, is underowned, and there's been a degree of angst with people worried about stock markets since 2008. And that's to be expected. I mean, there's still a malaise and a fear that hasn't been washed out of investors' psyches. And the fact that it's gone a record period of time, and we haven't had a 10% correction, long overdue in terms of historical reference points.
Right.
We've had a 219% increase since the bottom in 2009. So it's to be expected that there's going to be a decline at some point in time. Now, everybody thinks that's going to be the end of the world again. Well, not necessarily. It can be a healthy thing.
Right.
But there's been this constant fear that it's going to come, it's going to come. It's still so much an investor psyche. And I think anybody in this business is going to be lying if they say that doesn't affect them, the fear that their clients have.
Right.
So, the diversification that you want to have, and maybe you would be, I think what most of these managers are saying is they're not pushing to the outer ranges of their risk appetite, but they're staying neutral.
Yes.
But they have to be invested because, as we said before, zero interest rates. You can't not be invested just because you fear the market's going to go down at some point in time. Right. It's going to happen.
Right.
Ultimately, it's the 5 to 10 year perspective of what you're trying to achieve in your objectives.
Yeah, and also, I mean, Kevin, you could speak to a little bit what's going on in the emerging markets and what's going on in commodities, because, we do have diversified portfolios, and so, they're going to have their day in the sun probably coming up at some point again.
Well, we've talked about last time as well. I mean, your fixed income, you're not getting much yield, but you want to keep it conservative, and that's the price of liquidity and that ballast to your overall portfolio. In the previous 2 years or so, emerging markets, international commodities, diversification has hurt you. So how come we weren't all in S&P 500? Well, you look at year to date, emerging markets and international have outperformed. So diversification comes and goes, and it's over the whole full cycle. A point in comparison on the international side, their earnings are still well below where they were in their peak earnings in 2007. Their price to cash flow is on a valuation basis. Some of your other large firms out there view it as probably one of the better fat pitches that are out there in terms of opportunity. And you've seen that, especially in the last month, first quarter of this year. Through the end of March, emerging markets were actually down a little bit, and since the beginning of the quarter, they're up significantly, almost double digits. And as of international, have been the two of the top areas in terms of performance.
Well, it swings and comes back the other way around.
How come you weren't all in that?
So when we come back next time, we'll take a look at this. But we're seeing all this rotation taking place, and that's why you do have these completely diversified portfolios, because we just don't know where it's going to come from even day to day.
And another point you would make too is the S&P 500, the index, well outperformed most of the stock picking environment last year, and so far this year, where you've had this fear of a tepid growth and prospect of rising interest rates, and there's been this swing back to quality companies with earnings visibility. So the stock picking environment and the quality growth companies, you've actually seen come back in the first quarter as well, relative to yield oriented stocks or S&P 500 types or utilities.
It's always that, come back, mean to reversion situation.
Right, exactly.
Reversion to the mean and, all that good stuff. So we're going to see what happens here over the next couple of months. We'll come back in the summer and see what happens. Maybe we'll get a little more insight into what the Fed thinks they're doing out there, but I doubt it, the way it's been going lately. So anyways, have a great summer, and we'll catch you in another quarter.
Thank you.